Hey everyone, this is Aaron Philbeck here at Chi Association, and I am joined by Dan Cahill, who's the head of U.S. Defined Contribution with Partners Group. We're going to be talking about private markets in defined contribution plans. And Dan, I know this is quite a timely subject given some of the recent activity here in the U.S. So I appreciate you joining me for the conversation.
Happy to do so, Aaron. Thank you for having me.
Wonderful. Well, Dan, I think maybe to start on this conversation, as we're trying to figure out how does this work from an industry perspective, maybe the obvious statement here is that this is broader than just an investment conversation. There's a lot of other considerations that we need to think through as an industry, whether that's operations, product development, and so on. So, as you're working for a GP, what are some of the non-negotiables that the industry really needs to think through in order for this move into the DC market to be successful?
Thanks, Aaron. I completely agree with that. What I would say the most important initiative we have as general partners is to educate potential clients as to what we are offering and how we are offering robust private markets content. I think the majority of GPs out there aren't today prepared to offer portfolios to defined contribution participants or individual investors. Um, Although traditional drawdown strategies have been utilized in 401ks for probably 2 decades, it's not the most efficient way. It's generally only the most well-resourced plan sponsors, the largest plan sponsors that have been able to execute upon that. But as the market evolves, as innovation occurs, there are much easier ways for plans of all sizes to access private markets, generally through evergreen portfolios, which allow investors to access private markets content immediately. There is no J curve. There is no gap between the commitment and the drawdown. It also allows for client money to be immediately reinvested. What's most important about the evergreen structure, though, in my opinion, is the flexibility that it offers, which is so pertinent to the defined contribution channel. The evergreen capability allows a portfolio manager to be flexible with where that next dollar is going to go. Take advantage of relative value opportunities, provide liquidity if necessary. Um, Although it is a feature to have money be invested in a longer term opportunity through private markets, it's also important to be flexible because there will be cash needs for both participants and plan sponsors.
So I think product development is certainly top of mind for us as we look at the broader industry landscape. And there's a couple of differing options that are available on product design, and you can list the laundry list of all of this out. Target date funds, managed accounts, CITs. So if you put on your Dan Cahill crystal ball and where this is going to go from a product development perspective, where do you see the starting point for integration of private markets? And then what does end state look like for participants from just a pure product perspective?
I think the answer to that question, Aaron, first and foremost, is we think that private markets should be utilized by way of a professionally managed portfolio, full stop. Not dissimilar to how private markets have been utilized in pensions for close to 4 decades. Um, Private markets should be allocated to and from by a professional on behalf of an individual investor, a defined contribution participant. A plan participant should not be deciding when to invest into a private market solution. That's done on their behalf. And that's what the professional is hired to do. And that's what they have been doing for other retirement savings portfolios and high net worth portfolios and institutional portfolios for many years. And so this is just an extension of successful investment endeavors that have been leveraged for many years, but in other lines of savings. And so it's most important just to take advantage of what's been tried and true for many years. Um, that professionally managed portfolio could be a target date fund, could be a managed account. It can be utilized through a collective investment trust. And that's all evolving quickly. But again, it must be utilized by way of a professionally managed portfolio, where the professional consultant or portfolio manager is making decisions on behalf of the participant and choosing the most appropriate investment opportunity for their constituents.
And Dan, maybe there's a good parallel there to what we see outside the US. I mean, we clearly have a unique model of retirement in the DC space here in the US, but there's examples of whether it's the superannuation funds in Australia or parts of the UK, parts of the Netherlands that utilize this kind of trade off of professional management with access. So, how do you kind of compare and contrast what you just described versus what we see being successful in some of those other parts of the world?
Yes, absolutely. Well, I think here there are a few things at play. Number one, there is a very wide gap between what people have saved and what they need to have saved to have a comfortable retirement. So we need to do three things. Number one is provide enhanced access, more access to professional retirement plans, corporate sponsored retirement plans. People need to be able to invest into a 401k. Number two is they need to be able to save more, and so that's in auto enrollment, that's auto escalate. Make sure that people are taking advantage of the savings opportunities that they have. And number three, where they are saving, uh, make sure that they have access to the most robust investment opportunities that provide enhanced diversification, that have historically provided uh, have historically provided enhanced return potential. Other domiciles have taken advantage of these professionally managed portfolios for many years. The UK, Australia, and we endeavor to provide a more robust set of investment opportunities like those countries have. Partners Group is a global firm, and the reason that we've been able to be front-footed in this effort here in the U.S. Is because of our presence in these other countries, where we have successfully assisted participants and their professionally managed portfolio managers to access these private market capabilities.
Now, Dan, you talked a little bit about the defined benefit space and the professional management that's there. And I remember when I was prepping for this conversation, the leadership of Partners Group made some comments on the executive order from the Trump administration here in the US on how this push into DC plans from the private market space might actually bring some parity between DB and DC. And you can look at allocations, and there's obviously a large difference in terms of what those allocations look like. Where do you see that parity happening more quickly? And what are some things that might take longer to achieve that parity between DB and DC participants in the US?
Yes. Aaron, people say that we are in the early innings of this effort to bring private markets to defined contribution. It's even earlier than that. I think we're still in spring training. In terms of making sure people understand exactly what they can access and how. Partners Group's been at the forefront of making sure that we understand and we can educate our clients on what they have access to. Partners Group sought clarification from the DOL on what was permissible from an ERISA standpoint regarding the inclusion of private markets in defined contribution plans. And the response in that letter was, by way of a professionally managed solution, private markets can be utilized and frankly have been utilized by 401k plans for many years. But we're at the early innings in terms of adoption because the masses have not been able to take advantage. As we've talked about, it's only the most sophisticated and well-resourced plans that have been able to provide access to private markets. And that's what this administration is keenly focused on. One is, what's the most effective way to allow fiduciaries to make the best decision on behalf of their participants? One thing is clear, this might not be for everybody, but it has to be up to the fiduciary to decide on behalf of the plan and plan participants whether or not that's the case. And I know that Department of Labor is working towards the February deadline for the executive order. A large piece of that will be, how do we make it so that these asset classes, which are the majority of investment opportunity out there, given the state of public markets, how are these asset classes more accessible to the rank and file investors who need, frankly, who require access to what pensions have been accessing for many years, which puts them in the best scenario to retire successfully.
Dan, I want to pull on a couple of threads there. Maybe first on the sponsor side, and then talk about the participant side. On the sponsor side, I think one of the biggest barriers to adoption, and I'll say this wholesale, I worked with plan sponsors years ago, and the desire for simplifying, keeping costs low, a simple menu, all of those things were through the lens of, we don't want to get sued, we want regulatory clarity. And so in some ways, introducing these strategies, which may be better for the participant, goes against some of the rationales for simplification. So when you start to introduce things like complex fees and liquidity and valuation and operational considerations, it might cause a couple of these sponsors to tune out, which typically, as what you just said, the less well-resourced plans don't have investment expertise usually around the table. So maybe if you're sitting across from that plan sponsor, what are some guidance, things to think about, and tips that you would share for someone who's trying to manage both the participant experience and outcomes with litigation uncertainty, regulatory lack of clarity, and complexity wrapped around all that? So big question, but just curious how you would address that.
Absolutely, Aaron. Look, as we stated, we're at the early innings of this, and education is key to make sure plan sponsors know exactly what the options are for them, and if they intend to pursue adding private markets, how. Deputy Secretary Sonderling was speaking earlier this week on the fact that litigation, frankly, stifles innovation. And what his administration, what his Department of Labor efforts will entail is making sure that people are making decisions based on what's best for the participants, and not what will avoid them facing litigation. Will help, and not what avoids litigation. The most important thing that fiduciaries can do on behalf of their participants are to make sure that they are most prepared for retirement and retire comfortably. What we can do is continue to educate the market on what's available and how. We've done the majority of the work from a portfolio management perspective, from a product development perspective, that enables plan participants to access private markets by way of a professionally managed solution. We'll continue to educate as to how that professionally managed solution benefits the investor by being a large part of a target date fund or a managed account. But at the end of the day, it's all about education and making sure people understand what their options are and make the decision on what's best for the participant, and not what is the least expensive option. I think we'll get back to a defined contribution world in which decisions are made based on what's best for the participant, and we'll get away from regulation by litigation.
Yeah, absolutely. And I think that goes to your earlier comment on the professionally managed side of the experience for that participant, which I want to focus on maybe as a final question for you on the participant experience. Again, I remember going on floors and you're explaining the difference of what's a stock, what's a bond, what's a mutual fund. So the dispersion of education, even with basic financial concepts, is pretty wide from an education perspective. But maybe beyond education, how do you kind of see the experience for a participant changing as private markets become more mainstream in a DC plan? I mean, I think of things like QDIAs and eligibility and disclosure. Education is certainly an important part of that. But what does that experience look like, and how does it change when those are introduced?
The experience for a participant, Aaron, won't change much at all. The professional will be deciding what to invest into, how and when. And so we aspire to provide enhanced returns, better diversified portfolios for these participants, but it's only a small piece of their overall portfolio. Um, the majority of a retirement savers portfolio will remain in publicly traded, listed, liquid securities, and that's an important note to focus on, because um, in terms of product development, where the puck is going, it's well founded that because the majority of these portfolios are in liquid securities, um, some of the portfolio can be utilized with private markets. Align a long-term retirement goal with investment opportunities that are also long-term in nature. The entire 401k portfolio of a younger saver does not have to be in liquid assets, because frankly, that money should not be accessed anytime soon. The whole point of a 401k, the whole point of a defined contribution plan, is long term savings, and that aligns with the goal of private markets, particularly when the majority of the portfolio is actually going to be provided. Is the majority of the portfolio is going to be in more liquid securities.
Yeah, I think if there's any strong argument for inclusion, it's that structural, benefit of a long-term savings vehicle, and forcing you to take a long-term perspective, whether you have one or not. So, completely agree with that. Dan, maybe a final closing question for you. Anything else that we're not asking, or I haven't asked you that we should be focused on as an industry with this move that we're seeing, and interest that we're seeing in the DC market?
Yeah, thanks, Aaron. Look, I would say Partners Group has been working on this effort for quite some time. We've been in the market. We've been in the U.S. defined contribution market since 2015, and have been able to have a presence because of our evergreen portfolios. Evergreen portfolios allow investors to have immediate access to private markets, and that's really how defined contribution participants and their professionally managed portfolios should be accessing private markets. It's not a new concept, new for some GPs out there, but that's the most appropriate way for defined contribution investors to access this. What I would say is also, I think we're at the very early innings of how DC plan participants can take advantage of the broader investment universe, not just what's available in the public market sphere, which is important because look, our goal is to make sure people can retire and retire comfortably. We're a small piece of a much larger effort. Um, but our goal is to make sure that we can help our participants achieve their retirement success, um, and we'll continue to do so.
Great. Well, Dan, I really appreciate you sharing your thoughts. This is obviously, as you said, very early stages of adoption. And so here at Kaya, we're trying to figure out how do we ensure that the industry embraces innovation, but also protects the end investor at the end of the day. So appreciate your contribution to this conversation.
My pleasure. Much more to come. And I look forward to talking again as this all evolves.